Crypto Hotep here with another investing video. We are on week 103 of the Family Portfolio and Dividends Tracker. Thank you guys for tuning in as always. I really appreciate it. If you're unfamiliar with these videos, basically each week we go through my family stock portfolio. And if you're not familiar with it, go to the channel, go to week number 1. And you may want to watch that one first because then you can see how far we've come. But week number 1 goes through the whole methodology, the whole thought process, and basically you're following the investing journey with me and my family. But none of this is financial advice. Please do your own due diligence with stocks or crypto or anything of the sort. And as always, guys, if these videos are helpful, if these videos keep you going in your investing journey, please like, subscribe, comment, share. Let me know what you think about these videos. Let me know what you guys are investing in and what you guys think of the portfolio. With that being said, guys, we can jump in. Before we go to week 103, we kind of do a quick once over with any news and economic events that happened between this and last week. So this week was a short week due to Good Friday tomorrow. So most of the items that happened this week still relates to the Iran and U.S. conflict. It's been very volatile. I seem to be saying that day, week in and week out. But there has been developments with the talks with Iran and the U.S. between President Trump and the new president for Iran. Trump would say one thing, that the talks are going very well, and then Iran would say, well, nobody's talking to us. Trump would say one thing about something regarding oil, and then Iran would say the exact opposite of it. So the markets have, to say the least, have been just bouncing and dancing, basically, just on every single word in relation to this conflict. I think everybody just wants it kind of squashed and they want this done. There has been some good developments. I think Pakistan said they would host the ceasefire talks between U.S. and Iran. So that's good. That's good development there. But all in all, guys, it's just bad price action to be trading through. And if you don't have a strong stomach for this stuff, you may want to sit this one out here. So while this is still going on, expect the volatility in the markets. There was also the tariff implementation and inflation. If you remember, I believe maybe a month or two ago, Trump put a delay on tariffs on certain items, and he put that in play until a specific date. Well, that date has ended, and Trump did move forward with the 10% global section 122 tariffs. Okay, so he did go through with those tariffs. So now you have the Iran-U.S. conflict, you have the tariffs, and then you also have economic news with jobless claims, retail sales, and all this. Basically, it reinforced resilient but a softening labor market amid all this war and tariff noise. So again, not very good if you're trying to trade these markets. Not very good at all. Okay. A couple things to look forward to. The week of April 4th through the 10th, we have non-farm payrolls, more regional Fed speeches. Hopefully mid-April, we may have the Clarity Act. Hopefully that could get pushed forward, maybe finalized. And then April 28th through 29th is the next FOMC meeting. Okay. Again, before we go to week 103, let's go to week 102. And week 102 saw us with a balance of $3,895.07. Money weighted rate of return of a negative 4.88%. Yes, very nasty. And that's year to date. Market gain year to date of a negative $203.29, and then dividends earned of $11.49. So for this week was a non-contribution week, so we did not add any money into this portfolio. So, but we look a little bit better. So now this balance for week 103 is $3,954.94. Money weighted rate of return of a negative 3.36%. Still negative, but a smaller negative percentage. Market gain of a negative $144.74. And then dividends earned of $12.22. So what actually happened? Let's see what was going on between this week and last week. So we did get a little bit of dividend activity here, as you can see. So we got our dividend of Waste Management, 36 cents, Domino's Pizza, 29 cents, Coca-Cola, 40 cents, but the biggest one of all is for my wife with Pepsi, $1.32. Now, if this is your first time watching this video, take a look at week number 1 or week number 5 and see how small those dividend payments were. Again, we're just building these positions, and hopefully as we build these positions, we can increase those dividends. That's the goal, right? But one thing I am proud of, I'm proud of my wife's holding with Pepsi. It's just a singular holding here, and it is generating her the biggest dividend payout from anybody, and it just keeps increasing as well. If we do a filter really quick, let's just do a filter on just Pepsi, and then the activity type, let's just do dividends. You can see throughout the years here, we've done nothing but increased. So back in 2024, because we've been doing this for over 2 years now, we were getting dividend payments of 13 cents. Then we went to 14 cents, a quarter, 43 cents, 78 cents, a dollar. We hit a dollar. And then we've just been increasing. So we went to $1.31, and now we're at $1.32. Again, this should give you motivation for dividend investing. It's not necessarily the number, like the amount of dividends. It's the fact that you are increasing the dividend with each payment. Okay, so a lot of people get stuck on that number, and that's not where the game is, because you're going to be very disappointed, because dividend investing takes a long time to get going. It's like a snowball effect, but it takes very long to get going. So if you're just focused on overnight success or getting rich overnight, dividend investing shouldn't be in your back pocket at all. This is more of a long game with dividend investing. So very exciting to see with my wife getting the biggest dividend payment. I love to see it. And let's go to the portfolio, guys. So bottom to top, as we always do. Unfortunately though, we've had some shifting here. So the bottom is now belonging to my wife. So my wife's portfolio is at the last or is in last place versus everybody else in terms of balance. The balance is $556.31. Money weighted rate of return of a negative 10.27%. That's not very good, but we all know why here. Market gain of a negative $62.03, and then dividends earned of $1.60. So the culprits here, we have Google that's bleeding out, negative 6%. Pepsi, as we just said, with that nice dividend payment, is up almost 10.5% year to date. Fantastic. Microsoft, though, very similar to Google, bleeding out, down over 21%. Celsius down over 25%, unfortunately. And then Tesla down over almost 20% as well. So when you have those speculative stocks or those tech stocks, those take the biggest hits in these markets. When we have uncertainty, when we have conflict, when we have war, when we have those type of things that markets don't like, your tech stocks are your most volatile stocks. Those are going to go down so fast. Okay, so and we can see that here in my wife's portfolio. We got Microsoft, we got Google, and we got Tesla, three of the biggest names in the game. And then we have a speculative stock here with Celsius and Celsius Holdings. So again, we've been here before, especially with my wife's portfolio, because she's seen the ups and downs. I'm not making any adjustments. Again, if this is your first time watching the video, we don't do a lot of sales. We do mostly buys because we've done the research ahead of time for these companies, and we feel good with holding these companies long term in everybody's portfolio. Next up, let's go to our youngest. Our youngest portfolio is a balance of $573.66. Money weighted rate of return of 3.88% year to date, negative 3.88%. market gain of a negative $23.08, and then dividends earned of $1.06. So, very similarly, like with my wife, the tech stocks, Sony, Apple, Tesla, all bleeding out here. Apple doing better than most, but still in the red. The ones that aren't, the more established names, right? The ones that have a big foundation, right? The one that's been around for years, the ones that operate very boring businesses, but have been around for decades. Costco up over 17.86% year to date. You can't make that up. And then Starbucks still holding strong, up over 8%. Right? And again, that our youngest portfolio kind of shows the good side of investing when you diversify, right? You can over diversify with investing, but if you hit the sweet spot, if your portfolio is not all tech stocks, it won't be down so bad. So let's go to our middle stock. Our middle is surprisingly up here in the green. Our middle is like leapfrogged over my wife and then our youngest, and is in third now. We haven't seen our middle in third in a while. Very encouraging to see, but the balance for our middle is $578.62. Money weighted rate of return of 2.65%. Market gain of a positive, one of the only positives in the family portfolio, of $12.42. Dividends earned of $1.79. So what's the catalyst here? Well, the catalyst here is there are a lot of names that are very established. So we have Target. Target is up almost 25% year to date. Target is. Costco. Costco's up over 17.5%, very similar to our youngest. And then Starbucks up over 8%, similar to our youngest. Now, again, tech stocks, here we go again. Amazon, Sony, Google, Tesla, these are all bleeding. But again, when you look at the positions, the big positions, the anchors of the portfolio are the Target and the Costco. Those are the biggest positions out of any of these positions here. So that's going to hold that portfolio down very, very solidly. So very, very good showing here for our middle. Love to see it. Let's go to my portfolio. So my portfolio has a balance of $1,122.99. Negative 4.07% money weighted rate of return year to date. Market gain of a negative $51.80, and then dividends earned of $5.44. So with me, because I hold, I believe my holdings are at 10 or 11 companies here, I've sectored it out, and I have the companies in these sectors here. So technology, probably one of the worst ones of them all right now, down over 13%. Finance, unfortunately, is also down. Visa is down very badly. So Visa's down over 13%, then Moody's down over 13%. We may be looking at a reversal on finance stocks, though. Industrials and energy, up 0.29%. Real estate, which is the O Realty company, up over 11.85%. This has been my savior. O Realty has been my savior for the year. It generates income, it actually has appreciation, and it's just been doing fantastically this year. Consumer staples, up over 7.5% here. And again, Costco showing its name again. We love Costco. Our family does love Costco here, up over almost 18%. Lowe's, unfortunately, down over 3.74% here. Okay. And then pharmaceuticals, that's AbbVie. AbbVie's down. And then restaurants and food, we have the GOAT, Coca-Cola, up over 10.5, or almost 10.5, I should say. But Domino's Pizza down over 10.5. So it's kind of evening out here for the food and restaurant stocks. So overall, with my portfolio, again, I'm not too mad at it as of right now. There's nothing I would change. I still stand strong here, still buying the good companies, and that's all we can do in these times right now. Again, this is where, again, you have to have a longer time frame vision of your companies. This is not a flip these companies by night. Our portfolio is not that at all. It's investing in companies, rain, sleet, or shine, doing it consistently, and not stopping it, right? You know, as Charlie Munger once said, compounding, you should not interrupt compounding, right? If you can, right? If you can, don't interrupt compounding at all, because that's where the magic happens. And that's what happens when you do invest in those good companies, because that compounding really takes effect. Let's go to our Otis. Our Otis has the top spot with a balance of $1,123.36, down over 1.61%. Market gain of a negative $20.25, and then dividends earned of 2.33 or $2.33. So our Otis has not changed the portfolio at all. Still 4 slices. Still very simple. Tesla, McDonald's, Costco, Apple. I would say Costco and McDonald's are those anchors. Those are those like very established, well-known companies here. And then the tech stocks we have here, Apple and Tesla. So you got a good mix. I would say, you know, you got 2 established companies and then 2 very volatile tech companies. Even though Apple's not too bad as of right now, it's more Tesla. But all in all, you know, we've been in this spot before. You can take a look at the channel. You can kind of pick random videos and watch them. You'll see some red days into red weeks into red months for our portfolio, but guess what? We've always come out on top. So, but as always, guys, this is week 103 with the family portfolio and dividends tracker. For week 103, our balance is $3,954.94. Money weighted rate of return of a negative 3.36%, and then market gain of a negative $144.74. Dividends earned of $12.22. If this video was helpful, guys, feel free to like, subscribe, comment, please. Let me know what you think. And as always, thank you and happy investing, guys.